Well, greetings everyone, and welcome to the Law Hour and Editorial Review. The Law Hour is sponsored by the Gordon Law School of Isabella, Missouri. The Law Hour is an educational service brought to you in the public interest. I'm your narrator, George Gordon. All right, we're talking about silver. The inventories of silver have now shrunk to the point where there's now more gold in the world for sale than there is silver. In theory, all of the gold in the world is in a pile. It's in somebody's hands. Somebody's got it someplace, and it's for sale. Silver is a little different commodity. Silver is used in a number of industrial applications, such as photography, or it used to be. Now it's used in clothing. It's a disinfectant. It's used in medicine. It's used in nanotechnology, computers, electric circuit boards, and so on. And when it's used there, there's a certain amount of it that's recovered, and there's a certain amount of it that's lost forever. The cost of recovering $30 worth of silver out of a computer, for instance, may be worth going after. But for the small amount of silver that's put into, let's say, a pair of clothes or a pair of pants, the amount of silver is not worth recovering. And 1,200 tons of silver per year are put into clothes, and it's lost forever. Now, on the world's metal exchanges, it's reported that there's about 600 million ounces of silver for sale. That sounds like a lot. But on the world's metal exchanges, there are about 2 billion ounces of gold for sale. Now, silver appears in the world's crust 17 times more often than does gold. So therefore, there should be 17 times more silver for sale. For instance, if there's 2 billion ounces of gold, there should be 34 billion ounces of silver for sale, and there isn't. That's the kicker. There isn't. Now, that doesn't mean that there's a shortage of silver, nor that anybody has failed to deliver on a silver contract or a futures contract yet. But all of us who are watching the markets are waiting for that day to occur, and it's bound to occur. We don't know if it's going to be next week, next month, or next year. We've been watching this for 30 years. We all know, all of us that watch metals and the metals markets know, that silver is going to fail first. And it's going to fail more likely than not on the COMEX in New York. Of course, it could fail in London or Tokyo or someplace else, but the COMEX in New York is the market that all of us are watching. And we know that because silver and gold have both been sold out into the future in futures contracts 15 years into the future. Put another way, what we're practicing here is fractional reserve juggling of the inventory. It's a fractional reserve that we're dealing with here. In other words, there's 600 million ounces out there, and we mine about 600 million ounces a year, and we use that. And so what's being mined and what's being used is just about in equilibrium. But we have sold this in future contracts to people. There are people out there that are holding pieces of paper, and it says that I have 1,000 ounces of silver in somebody's warehouse. And in that warehouse, there's more than 1,000 ounces. Hell, there's probably 1,000,000 ounces. But there are 10 million ounces of paper outstanding against that 1 million ounce that's in the warehouse. So as long as you people out there demand 1,000 ounces here and 1,000 ounces there, there's no problem. We can meet that because we've got a fraction of the reserve, and we've got that in physical inventory, and we can meet these demands. Now, 18% of the people who deal in metals take physical possession, and 82% take pieces of paper. And the way the game is played is fairly simple. You call your broker, could be your stock broker. In our region, it's called Stiefel Nicolaus, and you place a futures order. Now, assuming you have an account and assuming that you've got money in the bank, they simply ask you for a check. You've got an account, and so you call up at 10 o'clock this morning and you say, I want to buy silver. They simply look at the price and they sell it to you at that price, and then they tack on their commission. And you've got a futures contract. They'll send you a bill, you write them a check, you send them the check, they send you a piece of paper that says that 1 year from now, let's say next July of 2010, you've got 5,000 ounces of silver due you. Now, you don't pay for the whole 5,000 ounces up front, you just pay 10%. So you pay 10% of the 5,000 ounces, which is, let's say, $15. So 10% of the $15, 150 times 5,000 ounces, and so you write your check and you send it in. Now, assuming that the price of silver doesn't go down, but it goes up to $16, you've made money. You can sell that contract at any time between now and next year and take your profit. That's what most people are doing. They're speculating. It's a gamble. They're gambling. I prefer the crap table. Some people prefer the metals market. Some people prefer stocks. Other people buy bonds. They're all gamblers. They're not investors. They're gamblers. They call themselves investors, but they're not investing. They're gambling. That's the bottom line. And in the metals market, it's I think the third largest market in the world. If you were to take a look at how much money is bought, sold, and traded in these metals markets, palladium, platinum, gold, silver, copper, so on. The London Metals Exchange in London does $10 billion a day. That's more than $3.5 trillion a year, and that's just one market. Now, it's not bigger than derivatives, but it's bigger than the stock market. Metals is a bigger market than stocks, and it's in the trillions of dollars a year. That's not bad, for a barbaric relic of the past, if you'll stop and think about it. These metals over here, bought, sold, and traded, they're bought, sold, and traded on futures contracts. Nobody ever takes possession of the metal. It's sitting over here in warehouses and stockyards and so on. And in some cases, people buy stocks in mining companies, which means they're really buying this metal in the ground. It hasn't even been mined yet. Now, gold is mined at the rate of about 2,500 tons per year. There's 32,000 ounces in a ton, so it's 2,500 times 32,000 ounces. That's how much gold there is being mined every year, round numbers. Silver, they're mining about 600 million ounces a year, quite a bit more. It's around 18,000 tons, as I recall. But it's being used up. It's used up every year in clothes and nanotechnology and so on. And what's happened over the years is that both silver and gold have been sold out into the future in these futures contracts by about 15 years. So, put another way, if everybody said, give me physical possession, somebody's going to get physical possession today, and somebody's got to wait 15 years. And that's just the bottom line. Unless you could juice up production and get production twice as high and cut the time in half. So tuck it away in your heart that if you have a piece of paper that says you've got so much gold or silver or platinum or copper or something else in somebody's warehouse, you need to understand that they don't have all of that copper, silver, wheat, corn, beans, honey, and oil. It's not sitting there in the warehouse. Not for everybody. There's a bunch there. And as long as everybody has confidence in the system, and as long as the system is able to deliver the physical property when it's demanded, which they've been able to do so far. But you see, those of us that watch these markets, we take a look at this and we say, well, 18% is physical, 82% is being traded on paper. In a crisis, the COMEX will not be able to pay. In fact, the COMEX right now is borrowing gold and silver from around the world in order to make those payments, to make the payments. Now that tells us that they're out. They've run out, and they're scrambling now to meet demand. And this as the recession gets deeper, as the depression takes on new meaning, more and more people are demanding physical possession, which is the purpose for our program here today. It's to alert you to the fact that if you don't already have physical possession, it could well be that you're not going to get physical possession. That's the bottom line. Not everybody is going to get physical possession of their gold and silver. When the run is on, and a run on the bank, a run on the metals markets begins when some market somewhere in the world is unable to meet physical demand.